I want you to imagine a miner walking into a shaft more than 100 years ago. He is not carrying a canary because he likes birds. He is carrying it because the mine is dangerous, in a way the human senses cannot detect early enough. Carbon monoxide does not announce itself. Methane does not ask permission. You do not see the gas. You do not smell the gas. You keep walking, thinking the mine is safe until your body discovers the truth too late. The canary discovered it first. When that bird fell, rational people did not stand around debating whether the bird was being dramatic. They left the mine. That is how I want you to think about California right now. California is not merely a state with unusual politics. It is a signal. It is a stress test. It is the place where ideas that are later normalized across the country are often tried first. And the signal coming out of California is very simple. The government is no longer satisfied with taxing what you earn. It is beginning to move toward taxing what you own. That distinction matters more than most people understand. Income is a flow. Wealth is a stock. Income comes in during the year. Wealth is what you accumulated after years of labor, risk, saving, investment, taxation, discipline, inflation, and mistakes. When a government taxes income, it is taking a share of the current flow. When a government taxes wealth, it is taking a share of the base itself. That is a different kind of machine. And once that machine exists, it almost never stays aimed only at the people it was first sold to the public as targeting. I have studied cycles long enough to know that systems usually do not break all at once. They break gradually. Then suddenly, the gradual part is where most people get fooled. They see the first version of the policy and say, that does not affect me. They see the first group being targeted and say, that is not my group. They see the first tax being introduced and say, that is only for people with much more money than I have. That is exactly how the income tax began. For much of early American history, the federal income tax did not operate the way people now assume it always has. In 1913, the federal income tax was introduced at 1% on income over $3,000. In today's money, that was roughly equivalent to an income level around $100,000. It was not presented as a tax on ordinary people. It was presented as a tax on the rich. That phrase is important because it is one of the most durable political phrases in modern history. Tax the rich. It sounds clean, it sounds fair, it sounds painless to the majority. It creates an emotional shortcut. You do not have to think deeply about incentives, capital flight, legal mechanisms, administrative systems, or what happens later when the tax base changes. You only have to think, someone else will pay. That is why the phrase works. But the mechanics are what matter. The income tax started small. It applied to a very small share of the population. People were told it would remain limited. Then war came, spending expanded, political promises expanded, the tax spread. Within a few years, the top rate jumped dramatically. By World War I, it had moved from a small tax into something much larger. By World War II, the top rate had reached extraordinary levels. But the more important change was not only the rate, it was the threshold. The threshold came down. That is the recurring pattern. The rate goes up and the threshold comes down. In 1942, Congress lowered the threshold so far that the number of Americans paying income tax exploded from roughly 13 million to roughly 50 million. People who had been told the tax would never reach them suddenly discovered that political promises made yesterday can become personal obligations tomorrow. That is the lesson. A tax sold as targeting the top can become a tax that reaches the middle. A tax sold as temporary can become permanent. A tax sold as narrow can become universal. This is not a theory about human nature. It is history. And when I look at California's current direction, I see the same machine being built again, except this time the target is not merely annual income. It is net worth, it is property, it is home equity, it is accumulated wealth, it is the balance sheet of the citizen. That is why the California situation matters even if you live nowhere near California. Many people make the mistake of thinking geography protects them from policy contagion. It often does not. Policy ideas travel, political slogans travel, fiscal problems travel, and when one state proves that voters will accept a new mechanism, other states and national politicians pay attention. California has a very large economy, a very large population, and a political culture that often serves as a laboratory for what may later be proposed elsewhere. So when a wealth tax idea begins polling with majority support there, I do not treat it as a local curiosity. I treat it as a canary. And I notice who is leaving the mine when billionaires and high net worth people leave a state. Many ordinary voters react emotionally. They say, let them go. They can afford it. They should pay more. They are too rich anyway. I understand that emotional reaction, but it misses the system. Level issue: the issue is not whether one billionaire can survive a tax. Of course he can. The issue is what happens when the tax base moves. If a small number of taxpayers provide a very large share of taxable wealth or taxable income, and those taxpayers leave, the burden does not disappear, it shifts. This is one of the most basic principles of systems. Costs do not vanish because the preferred payer is no longer available. The obligations remain. If a state has made promises, those promises still need funding. If pensions are underfunded, they remain underfunded. If programs have grown, they still require cash. If debt is accumulated, it still demands service. So when the highest value taxpayers leave, the state faces a choice. It can reduce spending, restructure obligations, or find new sources of money. Political systems almost always prefer the third option. They find new money. This is why I keep returning to the mechanics instead of the slogans. Slogans say tax billionaires, mechanics say build a system that identifies, measures, values, and taxes net worth. Those are not the same thing. Once the mechanism exists, the target can change. If the state establishes the legal and administrative power to assess wealth, to value assets, and to tax the total inventory of what people own, then the most important threshold is not $1 billion. The most important threshold is the existence of the system itself. After that, the threshold becomes a political variable. 1 year it can be billionaires, later it can be people worth $10 million, then $5 million, then $1 million, then anyone with a home, a retirement account, and enough equity to be called fortunate by someone who wants to spend against it. This is exactly how expansions of taxation tend to work. The first step is moral justification. The second step is administrative capacity. The third step is threshold adjustment. People focus on the first step because it is emotionally loud. But the second step is the one that changes the system to tax wealth. The government must know wealth. To know wealth, it must inventory assets. That means your home, your equity, your land, your vehicles, your accounts, your securities, your privately held assets, possibly your valuables, possibly your art, possibly anything with a market value that can be placed into an assessable category. That is a very different relationship between the citizen and the state. For most people, their home is the center of that issue. A home is easy for the government to see. It sits on public records, it has an assessed value, it has a deed, it has a tax bill, it can be reassessed, it can be compared against market transactions, it can be measured from above, it can be linked to debt records and ownership structures. If a government wants to find a large store of private wealth that cannot easily move, home equity is one of the easiest places to look. That is why homeowners should pay attention. Not because the first version of a wealth tax necessarily taxes your house tomorrow, but because the mechanism, once normalized, points directly toward the most visible, least mobile, easiest to assess form of household wealth. That is often the home. This is where many people say, that cannot happen here. I understand that response because it is psychologically comforting. People do not want to believe that the rules around property can change after they have spent a lifetime obeying those rules. They worked, they saved, they paid income tax, they paid sales tax, they paid property tax, they paid capital gains tax, they paid fees, they paid permits, they bought a home, they maintained it, they improved it, they built equity. Then one day they are told that the equity itself is a taxable resource that feels like a violation of the mental contract. But governments do not operate on your mental contract. They operate on laws, budgets, political incentives, and enforceable mechanisms. And when a government has unfunded promises, it searches for taxable capacity. California has made a great many promises: public pensions, public benefits, spending programs, infrastructure ambitions, social programs, administrative expansion, and the habit of solving political problems by promising more. There is a cycle here. Politicians get elected by promising benefits in the present and pushing the cost into the future. Voters like immediate benefits. Public employees like guaranteed retirement promises. Contractors like projects, programs, develop constituencies. Each promise creates a group that will fight to preserve it. Very few groups organize politically around the abstract future taxpayer, so the liabilities grow. Then one day the future arrives, and when it arrives, politicians rarely say we made too many promises and must reduce them. They say we need a fairer tax system. That is how the frame shifts. The problem was overpromising and overspending. The solution is presented as taxing accumulated private wealth. California's pension liabilities, failed spending programs, and enormous fiscal pressures are not incidental to this story. They are part of the causal chain. When a state spends heavily, promises heavily, and loses some of its most productive taxpayers, it must find a new base. The easiest political base to target first is billionaires. The easiest administrative base to eventually reach is property. That is the part most voters miss. They see the villain in the story and vote emotionally. They do not see the machine being built behind the villain. This is why I think in terms of second and third order consequences. The first order consequence is that billionaires may pay more. The second order consequence is that billionaires may leave. The third order consequence is that the state may need to replace the revenue from people who cannot leave as easily. Homeowners cannot move their house across a border. That changes the power balance. If you hold cash, you can move it. If you hold stocks, you can move the account. If you hold a business, you may be able to relocate it. If you hold a house, the house stays where it is. The jurisdiction can see it. The jurisdiction can tax it. The jurisdiction can reassess it. The jurisdiction can attach penalties to unpaid bills. That is why home equity is such an attractive target in a fiscal stress environment. It is not because politicians hate homeowners. It is because systems under pressure move toward what is available, visible, and enforceable. This is also why the surveillance and cataloging issue matters. People sometimes think it is impossible for government to monitor wealth in detail. But we already live in a world where private and public systems monitor, score, and classify financial behavior constantly. Your credit score is a simple example. 3 private companies effectively built a system that collects massive amounts of information about your loans, payments, accounts, and financial history, then compresses your behavior into a number between 300 and 850. That number can affect your mortgage, your car loan, your insurance, your apartment application, and sometimes even employment-related decisions. The irony is that the system does not merely measure risk. It shapes behavior. If you avoid debt entirely, you may not be rewarded the way a truly debt-free person should be rewarded. If you close accounts, your score can fall. If the system has errors, you must fight the errors inside a structure you did not choose. Then the same industry sells monitoring tools to protect you from the complexity and mistakes of the system it helped build. That is a private version of a financial cataloging system. Now imagine a government version aimed not at credit risk but at taxable net worth. The question is not whether the data infrastructure can exist. It already exists in pieces. Property records exist, bank records exist, brokerage reporting exists, tax reporting exists, credit databases exist, insurance records exist, aerial imagery exists, AI analysis exists, public records exist. The only missing piece is the legal reason to connect more of it into a recurring wealth assessment mechanism. A wealth tax gives the system that reason. That is the danger. It is not merely the rate, it is not merely the first threshold, it is the creation of a permanent measurement regime. And once measurement becomes normalized, enforcement follows. The deeper issue is ownership itself. People assume that if they bought something, paid for it, and hold title, they fully own it. But modern ownership has become more conditional than people realize. Companies have already trained consumers to accept this. You buy a device, but the software can be disabled. You buy a feature, but a company can remotely change access. You buy a piece of equipment, but repair rights may be limited. You buy a smart device, but a corporate decision can turn it into a paperweight. This is not the same kind of ownership that existed in a simpler age. It is permissioned ownership. It is access-based ownership. It is ownership wrapped in software, licensing, terms of service, and centralized control that matters because it conditions people to accept a subtle idea: you possess something. But another institution defines the real boundaries of use. When that mindset moves from corporations to governments, the implications become much larger. You possess property, but the state can continually reassess it. You possess equity, but the state can define it as taxable capacity. You possess records, but the state can require disclosure. You possess assets, but the system can impose an annual charge on the privilege of continuing to possess them. That is not confiscation in the dramatic sense people imagine. It is not someone knocking on the door and seizing your home on day one. It is more subtle. It is a percentage. It is an assessment. It is a form. It is a deadline. It is a penalty. It is a threshold that changes. It is a rate that rises. It is a compliance burden that grows. Systems usually become oppressive through administration long before they become visibly coercive. That is why I take the California example seriously. The ballot language may target billionaires. The political marketing may focus on people most voters do not personally know. But the deeper mechanism is a precedent. Can a state tax net worth directly? Can it require asset reporting? Can it value a liquid wealth? Can it create an annual assessment regime? Can it adjust the threshold later? Those are the questions that matter, and national politicians are watching. This is not a partisan observation. It is a systems observation. There are politicians with national platforms who have repeatedly supported wealth tax concepts. There are voters who believe the rich should be taxed more. There are fiscal pressures at federal, state, and local levels. There is frustration about inequality. There is anger about housing, inflation, medical costs, tuition, and retirement insecurity. All of that creates fertile ground for a policy that sounds simple. Take from the people who have too much and give relief to the people who are struggling. Again, emotionally powerful. But the question is not whether people are frustrated. The question is whether the solution creates a machine that later reaches far beyond the original promise. History says it can. That is why the income tax analogy matters. Nobody in the early phase of a tax expansion experiences it as the beginning of a century-long transformation. They experience it as a small, justified, targeted measure. Then the emergency comes. Then the spending comes. Then the threshold shifts. Then the rate changes. Then the tax becomes normal. Then people born into the later system cannot imagine that it was ever different. This is how policy becomes destiny. Now let me connect this to surveillance, because surveillance is how tax systems become enforceable. In the analog era, government monitoring was labor-intensive, files, agents, paper, human review. Even then, governments built systems to monitor citizens. During the Vietnam era, intelligence operations gathered information on hundreds of thousands of Americans, infiltrated groups, and continued long after the practical justification was weak. That tells you something about institutions. Once institutions gain a tool, they tend to use it. The digital era makes the tool far more powerful. Phone records, internet activity, financial accounts, images, cameras, transaction trails, location data, property records, algorithmic analysis. This is not science fiction. It is the environment we already live in. County assessors are already using aerial imagery and AI tools to identify property changes such as additions, pools, sheds, or other improvements that can justify reassessment. Doorbell cameras and private security networks have already created footage infrastructures that can be connected to law enforcement under various programs and requests. Data brokers collect and sell enormous quantities of personal information. Financial institutions report large amounts of data to regulators. Tax agencies already receive third-party information that ordinary citizens often forget exists until it shows up on a tax form. So if a government says it needs to measure wealth annually, it is not starting from nothing. It is extending an existing logic. That is why the private property issue is not abstract. Property rights are not merely about a deed. They are about the ability to own without continuous arbitrary extraction. They are about the stability of rules. They are about whether a person can plan across decades. They are about whether saving and investing are rewarded or punished. They are about whether the state sees citizens as owners or as balance sheets to be harvested. If people believe the rules can be changed after they accumulate wealth, their behavior changes, they move, they hide, they spend instead of save, they reduce risk-taking, they protect instead of build. Capital becomes defensive. That is not good for a society. Wealth is not only consumption by rich people. Wealth is productive capacity. It is businesses, housing, investment, savings, credit, jobs, and future tax revenue. When governments treat accumulated capital as a static pile to be skimmed, they often underestimate how quickly the pile changes behavior. This is why billionaires leaving California matters, even if you do not care about billionaires. Their movement is information. Capital flight is information. Behavioral change is information. The canary is information. And rational people respect information even when they do not like the messenger. Now, what should a person do? This is where I want to be careful. I do not believe in panic. Panic is a bad decision-making system, but I do believe in preparation. Preparation is what you do when you recognize that probabilities are changing. The first principle is to stop thinking only in terms of income. Think in terms of structure. How are your assets held? How visible are they? How mobile are they? How vulnerable are they to reassessment, litigation, taxation, or political targeting? What jurisdiction are they in? What legal protections exist? What liquidity do you have? What kind of debt do you hold? What kind of assets do you hold? These questions matter more in a world where governments are looking beyond income. A person who owns everything in the simplest possible way may feel clean and responsible, but simplicity can also mean exposure. Trusts, LLCs, legal structures, and proper planning are not only tools for the ultra-rich, they are ways of defining ownership, liability, privacy, succession, and control. They need to be done legally. They need to be done carefully. They need professional advice. Bad structures can be worse than no structures. But the general principle is sound. Do not wait until a policy is passed to learn how your assets are exposed. The second principle is diversification across asset types. If a system is moving toward taxing visible, immobile wealth, Then you need to understand the trade-offs among real estate, cash, securities, gold, silver, Bitcoin, private assets, and other stores of value. Each has risks. Real estate can be productive and inflation sensitive, but it is visible and immobile. Cash is liquid, but vulnerable to inflation and financial repression. Stocks are mobile and productive, but volatile and reportable. Gold and silver can be stores of value, but they do not produce income. Bitcoin can be portable and scarce, but extremely volatile and dependent on custody discipline. The right answer is rarely all one thing. The right answer is usually a structure that survives multiple scenarios. I have always believed that risk is not what people think it is. Risk is not volatility alone. Risk is being forced to sell at the wrong time. Risk is having no liquidity when the rules change. Risk is owning only assets that are easy for others to target. Risk is believing that yesterday's legal and tax environment will remain unchanged forever. Risk is not preparing because the first version of the problem appears to target someone richer than you. That is how people end up surprised. The third principle is to think geographically. Jurisdiction matters. Taxes are not only federal, they are state, county, city, district, and sometimes hidden through fees, assessments, and rules. A person who builds wealth in one jurisdiction may be treated very differently than a person with the same wealth in another. This is why people move. Not always because they are greedy, often because they understand incentives. If a state punishes accumulation while another state protects it, capital will eventually notice. People will eventually notice, businesses will eventually notice that movement changes the system. Again, the canary is not morally judging the gas, it is simply reacting to it. The fourth principle is to avoid political hypnosis. Do not allow emotional slogans to stop you from examining mechanisms. When you hear tax the rich, ask what reporting system is required. When you hear one-time tax, ask what prevents repetition. When you hear billionaires only, ask how the threshold can be changed. When you hear fair share, ask who defines fair and under what fiscal pressure. When you hear no one is coming for your house, ask whether home equity is already visible, accessible, and taxable. When you hear this will never affect ordinary people, remember the history of the income tax. That is not cynicism, that is memory. A society without memory repeats the same cycles and calls them new. I do not want you to be afraid. I want you to be awake. Fear makes people freeze or overreact. Awareness makes people structure their lives intelligently. There is a big difference. The practical response is not to run into the woods, liquidate everything, or assume collapse tomorrow. The practical response is to map your exposure, know what you own. Know where you own it, know how it is titled, know what taxes apply, know what your state is proposing, know what your county can see, know whether your property has unnecessary equity exposure, know whether your cash is losing purchasing power, know whether your assets are diversified enough to survive policy changes. Know whether you are relying on assumptions that are not written into law. Most people will not do this. Most people will hear a story about billionaires and vote with their resentment. Most people will not understand that a mechanism built for one class can eventually be used on another. Most people will not pay attention until the form arrives, the rate changes, the assessment rises, or the exemption disappears. By then, the easy preparation window may be gone. This is how cycles work. The people who prepare early look paranoid during the quiet phase. They look prudent during the transition phase. They look lucky after the system changes. It was not luck. It was reading the machine correctly. I am not saying every proposal will pass. I am not saying every wealth tax will become national. I am not saying your home equity will be taxed tomorrow. I am saying the probability distribution has shifted. And when probabilities shift around property rights taxation and government surveillance, serious people adjust. That is the whole point. California is showing the direction of travel. The income tax shows the historical pattern, the pension liabilities show the fiscal pressure, the technology shows the enforcement capability, the billionaires leaving show the behavioral response, the political slogans show the emotional pathway, and the home sitting on a public record with an assessed value and visible equity shows where the mechanism could eventually reach. You can ignore that. Many people will. You can mock it. Many people will. You can say it is only for billionaires. People said versions of that before. But if I were standing in a mine and the canary fell, I would not spend my energy insulting the bird. I would look for the exit. And in financial life, the exit is not necessarily a physical door. It is a better structure. It is a stronger balance sheet. It is more liquidity. It is more jurisdictional awareness. It is better legal planning. It is assets that cannot all be reached through the same channel. It is a war chest not only of money, but of options. Options are what matter when rules change. The person with no options must accept the new rules exactly as they are handed down. The person with options can adapt. That is the difference between being under the machine and being beside it. The hardest part for most people is emotional. They want the system to be fair. They want the rules to stay the same. They want their past responsibility to protect them from future policy changes. But systems do not reward what you want them to be. They reward understanding what they are becoming. This is why I study history, debt, politics, incentives, and human behavior as one connected machine. Taxes are not only tax policy, they are incentives, they are power, they are claims on future production, they are claims on accumulated savings, they are also stories told to voters. If you only listen to the story, you will miss the claim. The claim is what matters, and the claim now being tested is a claim on net worth that is new enough, large enough, and dangerous enough to deserve your attention. Maybe California stops it, maybe courts limit it, maybe capital flight makes it politically harder, maybe the first version stays narrow for a long time. All of those are possible. But possibility is not the same as safety. The point of preparation is not to predict perfectly. The point is to survive being wrong in multiple directions. If nothing happens, a stronger structure still helps you. If taxes rise, a stronger structure helps you. If inflation persists, diversified hard assets help you. If surveillance expands, privacy-aware legal planning helps you. If property taxes rise, liquidity helps you. If wealth taxes spread, jurisdictional flexibility helps you. That is how I think about it. Not panic principles, not prediction, preparation, not politics, mechanics. That is the Dalio way of looking at a situation like this. Find the cause and affect relationships, study the cycle, look at the incentives, separate the emotional headline from the structural mechanism. Then build a life that is robust enough to handle the likely consequences. The headline says billionaires may be taxed. The deeper story says governments under fiscal pressure are looking for new claims on private wealth. The headline says California. The deeper story says policy laboratories can become national templates. The headline says fair share. The deeper story says inventory valuation, threshold adjustment, and enforcement. The headline says the rich. The deeper story may eventually say homeowners. That is why I am paying attention. And that is why you should too, because if you wait until everyone agrees the gas is real, the canary has already done its job. The question is whether you acted when it fell.